Welcome to Java, and thank you kindly for joining me. It's September 9th, 2024, from Monday. There's quite a bit that happened over the weekend, over the past week, and I did not do a markets look ahead. So, missed that. We've got quite a bit to cover. So, let's go ahead and get started with where the markets are right now. So, we had quite the pullback last week. Very weak markets, not any kind of surprise to us. We were watching what was going on with the elements. So we've got our favored risk indicator right now sitting at 237 now. I expect this to move a bit on market open. The two elements of it, the 10-year yield as well as the relative strength of the dollar, both edging up slightly. Now we've got the fear greed meter significantly dropped, went all the way from greed territory all the way down. Now it's in fear territory at 39. So significant sentiment shift in the market. So with this, we've got cryptocurrencies are recovering already, along with the strength of the dollar and the 10-year yield. I'll talk a little bit more about how these are all playing together. Now, the sentiment at the moment, and I expect on open, is a bit of recovery, if only temporarily. So I'm urging you to watch the strength and volume if you're trading on these, particularly day trading, because otherwise could have significant sharp moves short term and kind of wash you out of your trade. So you want to avoid that. So look for moves with volume behind it, and that will kind of give you a good sense of that. At the moment, we're showing US stock markets, they appear red. However, I think that will shift shortly after open. We've got the futures are looking green, so they are in agreement with this, that there's going to be some temporary strength. And I say this for a few reasons. As I was saying, the recovery, not just with the strength of these cryptocurrencies generally lead. We've got the fear trade gold dropping a bit. So it's still above 2,500, and I don't expect it to get super weak. But with these and oil also getting a little bit weaker, it's below the $70 level. So with all of this, taking a look at the other markets on open now, Asian markets were weak, and I'll talk about this a little bit more in a bit. We've had European markets, on contrast, opening in the green, very strong. Why am I talking about all these markets that don't necessarily matter to you? Is because they do. So I'll talk about that in a moment as well. For now, the market week calendar that we are looking at, we're looking at some wholesale inventories, and then the large one normally was the CPI for Wednesday. However, since they're no longer looking at inflation numbers as closely as they were prior, unless they're way off with the reports, as long as they stay in line, it won't have an effect on the Fed decision. Now, we know that they pump these. They've been kind of basically buying a lot of this debt on the other side, and they are bolstering markets. So Thursday, I think, will be the large one with the jobless claims. They've got core PPI and some other reports coming out. Really looking forward to the following week, because the whole market is looking forward to the rate cut decision that they've already got priced in. So when they finally make that decision, it's probably going to be a sell the news event afterwards. So it should kind of build and grow. Probably until then is the likely more probable. Nothing is a guarantee. So the jobs numbers will outpace CPI or PPI, and neither of those are more important than September 18th. So with that, let me go a little bit more into, we've got earnings still for this week. However, not a lot of large ones. There's a few in here, but all of the larger Mag 7 have done their reporting. So nothing that will be huge enough necessarily to move the markets. Now, one here, Big Lots, I'll talk about in a moment. Now, with this global issues with these markets, we've got the consumer getting weak. More importantly, the largest consumer on the planet basically is the American consumer, and they are getting weak. So we've got a few graphs and support here from Bankrate. They do They do some different graphs here. Basically, they run polls as well. So they've got this showing what is going on. 1 in 4 people have no emergency savings. If they had something come up, they don't have a way to pay for it. Okay. Over half of Americans are uncomfortable with their level of emergency savings. This one, I think, is an important metric for the markets in general. More than 1 in 3 Americans have more credit card debt than emergency savings. So, again, living off of the debt bubble. Again, nearly 1 in 3 have more emergency savings than they had a year ago. And more than half of Americans would not be able to pay for a $7,000 bill from their emergency savings. So basically saying more than half of Americans have less than $1,000 in savings in US dollars, which has been deflated. So that's quite weak. So if we've got this chart up here, basically is how they would deal with an unexpected expense. And you can see paying from the savings, 44% of that. The rest would try to either monetize their debt, borrowing it, or family or friends. So getting weaker. With this, I'd like to skip over to something in a little bit larger context. If you want to know what CBDC looks like in the United States being adopted, this is it. FedNow advances toward making real-time payments mainstream. That's central bank digital currency, because you're basically trading on that electronic platform in digital notes, which is basically tied to loosely, I use the term US dollar, but it's the real-time payment. So behind this, what are they saying? Let's take a look at this, because this now, the larger issue is currency. We've got currency wars going on and trade imbalances, and I believe that is going to be larger, short of nuclear, going to be larger than the physical wars coming up here very soon. So we've got Western financial policies driving countries away from the dollar. This is an Asian marketing currency expert, but basically, we know they've been kind of pulling away from it for some time with BRICS. We had the Pentagon chief say that a 6-month temporary budget bill would have devastating effect on the military. Why am I talking about this here? Because the US dollar is not backed by any commodities or anything of value. They're simply backed by the strength of the United States military. So, if they say a 6-month temporary budget would have that much of an effect on their strength, that just means they're going to print it to bolster it back. They are not going to allow the strength of the military to go down significantly. So this is all a bit of a wash for story. That is the excuse they're starting to float out, so that it will be acceptable very soon here that we need billions of dollars to funnel into the US military. With this, I want to bring up Germany. They've got a 10-year bond yield edging higher. Now, the reason for this is because less people are investing in Germany. Germany is very weak at the moment and on the edge of basically collapse. So if there were one to go first in Western Europe, it would be Germany at the moment. And this is why this story is from last week. But Pentagon leaders heading to Germany, they've been having talks this entire time behind closed doors, and talking basically about how they can bolster the weapons, running weapons trades through Germany. And this will monetize them because this is based on the war economy. So I want to skip over a little bit with this side of the currency to the Asian markets. And this is more of a risk growing still. And it's Japan's economy is growing, but political uncertainty posing a risk. Now, the economy is stronger through tourism mostly. Their GDP is down. So with their GDP down, that again is affecting their trade. Right now it's being made up for in tourism, but that is going to slow soon. So we've got even Morgan Stanley saying that the yen carry risk trade still lingers for stocks. I agree with this. The unwinding we've seen has been in two currencies, and it has not even touched the upper probably 5%. It's so heavily leveraged that it's massive, and it still has not come down. So with this, we've got Brad saying that demand for a Japanese yen stable coin is only a matter of time. Well, I agree with this because they're going to need to revalue. And one of the easiest ways to revalue is if they moved to a CBDC or a stable coin, if you will. So a couple of other things I would like to bring up with this. This goes behind this. We've got the United States trade rep describing a new era of globalization. So what does this mean if we translate this? This means basically that the United States is about to suck the value out of every other country that does level trade with them. Because right now, the United States is trade deficit. They don't make anything. They've been running a deficit for years. And the way they level this out is going to show through this, she's saying globalization, but really it's going to be a form of inflation theft to other countries. So with this, we jump over to China. They've got major risk of deflation at the moment, and this is growing as signs of their economy weakness mount. Why do we have to watch them? Because they're tied in deeply in commercial real estate still with the United States economy. So all of these loans also leveraged. We cannot just decouple from China. Going over to Europe, the ECB's economic hopes are at risk. Consumers are putting spending on ice. They're suffering from same issue, weakening consumer and the spending. So it could be credit freeze. They will need to basically ease their policies soon to create liquidity. In the meantime, on the other side, we've got all central banks. It's not just Russia, but this is about Russia. Their gold reserves, physical gold reserves, approaching historic landmark, 190 billion, according to the central bank holding bullions. They are massively hedged against what is about to come, what they see. So with this, again, we've got another story I was going to talk about. Big Lots. They filed for bankruptcy. So this is just one more retailer couldn't handle it. Filing Chapter 11 is going to sell off for pennies on the dollar. Meantime, we've got banks as corrupt as ever, the United States, but also global. Massachusetts fining Morgan Stanley over trades by the First Republic CEO. Now he's trading into the SVB collapse, which has exacerbated many of these issues that we've got now, also leading into more of the issues that we're having with Russia as they basically liquidated some of their reserves in that bank to pull back. Now we've got more banks that are going to close, merge, or be shut. We are only at the beginning of that. I would say maybe 15 to 20% of the way through the small banks that must fail, as well as the unemployment. We've got massive unemployment coming. Now, companies have stopped hiring, but they have not begun to lay off yet. They have not really begun the major layoffs that are coming forward. There has been some, but we're not anywhere near where it's going to be in the next, probably the next year or so. I expect that to accelerate as well. So with this, I wish you all a green trading day if you're trading. Otherwise, just a wonderful day in general. And thank you kindly for being with me. Until I see you again, stay free.